The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.
For millions of Americans who retire every year, the task of ensuring that your money is working hard enough to provide you with a consistent paycheck can make the job of working for that paycheck seem easy. Retirement doesn't signal the end of financial worry. In fact, for the majority of retirees, it's just the beginning. The assets you have built must be able to provide you and your family with financial security for all the years to come. That's why you need a game plan for retirement. America's retirement income coach, David Gaylor, author of Income Allocation, and his team of professionals will guide you to and through retirement, making sure you have a plan and that your money is working hard to provide you with an income you can depend on. This is your game plan for retirement.
Welcome back to Your Game Plan for Retirement with David Gaylor, author of the book, Income Allocation. One thing that's vitally important when we're talking about setting up a proper game plan for retirement and the income allocation is identifying the income gap. Can you talk to us about what the income gap is, how do we identify it, and then what are the proper steps to fill our income gap?
Peter, as far as retirement planning, one of the most critical things we can do is establish what the income gap is and whether or not there actually is one. So basically, we need to look at someone's budget, and then we need to compare that budget, and we need to be generous with the budget. We need to allow travel, and we need to allow how they want to live. So there's two things that I want to see when someone comes in to see me. First, I need to see a bare bones budget. This is absolute survival here. Second, this is how I want to live, and generally there's a pretty decent difference between the two numbers. But what we need to compare that to is their guaranteed income sources in retirement. That would be Social Security, pension, any other income sources that they have that are from a guaranteed source. If those guaranteed sources do not cover even the basic lifestyle, then we have an income gap. If it doesn't cover the desired lifestyle, then we have an income gap. So let's say, let me put numbers to it. Let's say I need $5,000 a month to live the way I want to live in retirement, $3,500 a month just to live, and my guaranteed income sources are $2,500 a month. Well, then I have $1,000 shortfall, a $1,000 income gap, and we're going to have to make that up somewhere. Either I have to keep working or we're going to have to get the money from investments. And both of those things are problematic because I can't probably work forever. If I have to get it from investments, now I have a problem because my guaranteed lifestyle is being funded from basically my savings, which that's most people's concern. What if I run out of money?
Well, that savings that you have by the time you retire during your working career, that's kind of an income surplus. So that's on the opposite side of this. As you are bringing in money, what it didn't take to meet your bare necessities or what it didn't take to live the way you want, that's generally what you have left over in that pot. So we're going in a different direction here. Money was going in, creating that income surplus and the savings that you have been able to build up. But now that we're in retirement, you're saying that it's problematic to pull money out of that to cover the income gap, and we need to figure out a better way of going about that?
Absolutely. Over the last generation, we have been conditioned to retire a different way than the generation before. The generation before retired with pension, Social Security. They're the most financially secure people I've ever spoken to. They had a relaxed retirement. Most of them knew that they knew exactly what their income was going to be on the day they retired, and they knew what their bills were. So, if you think about it, during our working years, our financial security comes from our income, our annual income, but that paycheck every week or every month or biweekly, we know that that's going to cover our expenses. And generally there's something left over that we put some money back for retirement, and something left over we can take some vacations on and go out to eat. But in retirement, all that changes for most people, especially those retiring today that have a little higher lifestyle, and maybe they're going to be Social Security is their only income that's going to be coming in. So yeah, those people are going to retire with an income gap, and it's going to be very, very different from their working years.
So the income gap of today's retiring generation, the baby boomers, is maybe greater even than the generation before them. The greatest generation didn't have this income gap issue, is what you're saying?
Absolutely. And again, most people, if you're listening to the show, you haven't heard the story of my 94-year-old client, but this gentleman, he was my client for over a decade. He never withdrew a penny from his savings ever. We had a review with him, his wife, and his children. He's 94, she's 91. And I asked him, why haven't you withdrawn any money? He said, I don't need it.
That's another thing about the greatest generation. They didn't spend money that they didn't need to spend. So that maybe helps to close that income gap a little bit as well.
Yeah, they were fantastic savers. Most lived in the same house for 30, 35 years. I don't know too many people today that do that. My wife and I have moved a few times, and we've been married. This is our 30th year of being married. But yeah, when I spoke to this gentleman and he answered that way, I had to drill down and find out what we were talking about. And he told me, Peter, he'd been retired for 32 years. 32 years. And every month during that period of time, when he and his wife got up, and he retired at 62 and he's 94, they knew that the bills were paid, the pension and the Social Security. They're saving money from that income. So their bills were covered. They could travel. They did whatever they wanted to do. And their savings was merely extra money. They did not need it to fill an income gap to fund their lifestyle.
Well, David, you're kind of reminding me here of the old carpenter saying of measure twice and cut once when it comes to this income gap. Carpenters and builders are very careful when they are building something to measure twice and cut once, because builders know that leaving a gap is not structurally sound. And you're talking about building somebody's financial structure on a foundation of income. So leaving this income gap for today's retirees is not structurally sound to provide a secure retirement and the income that they're going to need.
You're absolutely right, Peter. And, we measure twice. And by that, what I mean is I need to know what your absolute bare bones, this is survival budget is. And then I want to know this is really how much I need to live the way I want to live. My goal is that we cover how you want to live with guaranteed income. And again, that's going to leave us money left over to invest and grow. And you know what? You're going to have a surplus of savings throughout your retirement that you can spend from, and you can spend more freely because you know that your lifestyle is covered. So we're not spending money that you might need down the road 20 years from now, 10 years from now, just because maybe a market correction or something didn't go as planned. But again, it's so critical that we cover your basic living expenses, but more importantly than your basic living expenses, your desired lifestyle with a guaranteed income.
Well, this is sort of akin to finding out what your retirement number is. And we take it a step further, David, here in talking about the income gap. You're talking about how much money it will take to cover a specific amount of income into the future and identifying what people really need to be targeting in order to know that they can retire comfortably. Are these things that you're talking to people about beforehand as they begin to retire, or is that something that you have additional conversations later on down the road?
Well, both cases, Peter, because, we do pre-planning for retirement with a lot of people. We'll see people who are 10 years away, 5 years away, but we also see people that come to us that are 5 years into retirement. And at either time, it's an appropriate conversation to have, because you can't just take some basic fundamental withdrawal of 2, 3, or 4% from an asset allocation model and expect all of these different things to work out. We're leaving too much to chance there. My retirement lifestyle very much is going to be predicated upon how the stock market performs during the first 5 to 10 years of my retirement. When we talk about sequence risk, that's the period immediately before and about 5 to 10 years after. So if we factor in longevity and we factor in inflation, whenever we look at, let's say I'm going to begin withdrawing $30,000 from my portfolio, and then the next year it's going to be 31, and the next year it's going to be 32. Well, 30 years down the road, that might be $60,000. How am I going to make my portfolio last through 3, 4, or 5 market corrections? Because the market tends to correct every 5 to 7 years. How am I going to make my portfolio last through that many market corrections, potentially rising tax rates, with inflation, the potential for rising healthcare costs? There's so many things to factor into this that just starting off with some allocation of mutual funds and hoping for the best, generally, I just feel that we're leaving too much to chance there. And I really, really prefer certainty when it comes to knowing that my lifestyle is covered.
Well, there are a lot of benefits to you to identify your income gap and set up that income allocation early on, folks. Generally, an income allocation model can beat the 4% model from Wall Street on the amount and on the certainty of income that you can produce in retirement. That leaves you more discretionary funds to spend on vacations or to grow for needs later on down the road. Extra purchases will not deplete your income base if you have the proper income allocation model set up. And you can feel a little bit more confident, rest assured that ups and downs in the market aren't going to wipe away your ability to produce income. So the bottom line is that if an income allocation isn't what you have saved for, then really what is? You need to figure out what your income gap is and solve for that income gap so you know you have the foundation, the structural integrity for your financial house that you can depend on being there throughout your lifetime. And that's what the book Income Allocation is all about, and that's what the message that David Gaylor, America's Retirement Income Coach, gives here on Your Game Plan for Retirement each and every week. And folks, if you would like to sit down and identify your income gap and have an income allocation model built for you, pick up the phone and give a call to your local income allocation advisor in Charleston and the surrounding Coastal Carolina area, president and founder of Coastal Financial Planning Group, Rick Durkee, at 800-491-6220. That number again, 800-491-6220. And I think this is even appropriate for folks who feel like they have more than enough to generate the income they need. And that's a great feeling, but wouldn't it be nice to use less of your asset base to produce more stable, secure income? Again, David, that's really what the income allocation model is all about, isn't it?
Peter, this is about creating safe leverage. It's about choosing vehicles that allow us to use less of someone's money than an asset allocation model to generate the same amount of income. The income allocation payout might be 5 or 6%, as opposed to the asset allocation withdrawal rate of 2%, which means I need maybe 1/3 of the amount of money to create the same amount of income.
Well, folks, if that sounds like a plan for retirement that you'd like to learn more about, pick up the phone and give a call to your local income allocation advisor, president and founder of Coastal Financial Planning Group, Rick Durkee, in Charleston and surrounding areas, your local resource for the type of information and planning that you are hearing on the program. He can be reached for a complimentary financial review and evaluation at 800-491-6220. Again, that number, 800-491-6220. I do also want to mention that Rick Durkee has several different ways that you might be able to see him in upcoming events in and around the Charleston area. And just to let you know of a few of those throughout the coming months, Rick Durkee has his event coming up that is the Learn to Lead, where they are sponsors, and that is October 7th coming up. If you would like to attend the Learn to Lead Summit, pick up the phone and give a call, or the Retirement Planning Summit 2 is another great opportunity, and that's coming up in November, as well as a couple special dinner events that are by reservation only. If you would like to find out when some of the upcoming dinner and financial events are coming up at some of the great steakhouses in the area and would potentially like to reserve a seat for yourself or maybe you and a spouse, pick up the phone and give a call to the team at Coastal Financial Planning Group. Again, the number 800-491-6220. That's 800-491-6220 to speak with president and founder of Coastal Financial Planning Group about your own income allocation plan. He is Rick Durkee, and he does extend that offer on a complimentary, no-obligation basis. Or if you'd like to find out more about one of the upcoming events, such as the Learn to Lead Summit or the Retirement Planning Summit or one of the great dinner events, again, just give a call to Rick Durkee and Coastal Financial Planning Group, 800-491-6220. That's 800-491-6220. We're going to shift gears here on Your Game Plan for Retirement. We have a very special guest. He is a multiply published financial author in his own right. He's author of the book Paychecks and Paychecks, as well as the author of the book Don't Worry, Retire Happy, which has also turned into a PBS special on retirement success. He is retirement guru Tom Hegna, now joins us on the program. Tom, we certainly appreciate you spending some time and joining us here on Your Game Plan for Retirement.
Thank you, Peter. Great to be with you.
Well, it's great to have you. You have written extensively about retirement. Can you share with the listeners what are some of the unprecedented challenges that are facing today's retiring generation that maybe we have not seen before?
Yeah, well, I'll tell you, I'll start out by saying I'm a reluctant author. I never wanted to write a book. I didn't dream of writing a book. It wasn't on my bucket list. So why did I write a book? Well, here's why. Because right now, if your listeners talk to 50 different financial advisors and ask this very simple question, how should I retire? They're probably going to get 50 different opinions of what they ought to do. But you see, retirement's been studied in depth by PhDs all over the world, people like Dr. David Babel of Wharton and Dr. Moshe Milevsky of Toronto, Dr. Menachem Yaari of Israel, most recently Dr. Robert C. Merton, a Nobel Prize winner, who was just published in the Harvard Business Review. Well, I've read their research, and you know what the research says? There are not 50 optimal ways to retire. There's really one optimal way to retire, and that's not my opinion. It's based on mathematical, scientific, and economic facts. So what I write about is the math and science of how to retire the optimal way. You know, nobody knows what will be the best way, but I talk about the optimal way, and optimal simply means it'll be the best more often than anything else will be the best, and it'll never be the worst. You know, to get to your question of what these people are facing, they're facing a life where most people don't have a pension anymore, and at a time when they need guaranteed lifetime income more than ever. They're living longer than ever. The market is very volatile. We printed $4 trillion. The government's $19 trillion in debt with $100 trillion of unfunded obligations. There's a lot to be worried about.
You've written extensively about these mathematical and scientific formulas. How do we arrive at our own mathematical or scientific equation in our own individual retirement preparedness?
Yeah, so Paychecks and Paychecks, there were 4 simple steps, and Don't Worry, Retire Happy 7. So let me go over the 4 simple steps of Paychecks and Paychecks. Step number 1, you got to cover your basic living expenses with guaranteed lifetime income. So figure out how much you need to live, you know, month to month, day to day, and that should be covered with guaranteed lifetime income. So that's not where stocks fit, that's not where bonds fit, that's not where real estate fits, that's where guaranteed lifetime income fits. But then step number 2, you need to optimize the rest of your portfolio to protect yourself against inflation, because you can't just have a steady income the rest of your life. You have to have increasing income for the rest of your life. That's where stocks and real estate and other things can fit. Step number 3, you got to have a plan for long-term care. See, that's the one thing most people forget about that can wipe out their entire life's work. I say no retirement plan is complete without a plan for long-term care. And then step number 4, the most efficient way to pass your wealth to your children and grandchildren is with life insurance. I tell people all the time, don't leave your kids any money. Spend your money. Leave them life insurance, because you can leave them so much more for so much less. So those were the 4 simple steps based on math and science on how to take key risks off the table and how to make sure you're going to be happy. And then I expanded on that in the TV special and the other book, Don't Worry, Retire Happy.
And you go into depth on what some of those key risks are. Can you explain a few of those key risks to retirement?
Sure. I mean, if you think about it, there's quite a few risks. There's market risk. We've seen that. Markets can go up, markets can go down. If they crash right before you retire, you're in big trouble. There's withdrawal rate risk. You might take out too much money. You know, what's the safe withdrawal rate of taking money out? There's this thing called sequence of returns risk that people don't understand. We could do a follow-up on that if you want to. We might have inflation, might have deflation. You might need long-term care. You might die. You might live a long time. There's a lot of risks in retirement, but when you study it, there's only one number one risk. And the number one risk by far, nothing if even close, is longevity risk. Because longevity is not just a risk, it's a risk multiplier of all the other risks. See, if you think about it, the longer you live, the more likely the market will crash. The longer you live, the more likely you're going to take out too much money. The longer you live, the more likely inflation will decimate your purchasing power. The longer you live, the more likely you're going to need long-term care. You see, if you retire when you're 65 and you drop dead when you're 68, it doesn't matter if the market crashes 10,000 points. It doesn't matter if inflation is 15%. It doesn't matter if you were drawing 12% a year. It doesn't matter if you forgot to buy long-term care insurance because you didn't live long enough. But if you live to be 75, 80, 85, 90, it's all those other risks that can wipe you out.
So, Tom, why has the general public been reluctant to adopt some of these scientific and mathematical formulas that you say can help overcome some of these key risks?
Well, because, look, in the 80s and 90s, the market was going so well. Everybody was a saver and investor, and they were investing, and they were in the market. It was all about diversification and asset allocation, and they were just making money and making more money, and the 401k was going up. Well, then 2000s hit, and we had 2 major market crashes in 2000 and 2008, and the 401ks were turned into 201ks, and then it happened again, and some people are out, they're bitter, they're never going back in. And when you're an investor and you're a saver, you have one mindset, and that's diversification, allocation, and that type of thing when you're growing retirement funds. But once you're in retirement or nearing retirement, once you get in your 50s and 60s, you can't can't do that anymore, okay? Because if you lose money right before or right after retirement, it can devastate your whole retirement. So once you get into the retirement phase, it's way different than the accumulation phase. If you think you're going to retire with a portfolio and just withdraw money off it, I'm telling you, that isn't going to happen. That's the way you run out of money. And so in the distribution phase, what you've got to have is you've got to have guaranteed lifetime income. You've got to take longevity risk off the table. You've got to take long-term care risk off the table. You've got to take withdrawal rate risk off the table, sequence of returns risk off the table. So you've got to take these various risks off the table to retire successfully. And that's what the math and science shows. These aren't my opinions. These are what all the PhDs who've studied retirement say you've got to do. And it's really a simple formula once you figure it out.
And we've spoken on this show about the importance of having an income plan for retirement, or an income allocation, as we have called it. That income allocation is vastly different dynamically than the old asset allocation that you are discussing. Can you discuss some of the key differences there and why that income plan is so vital for retirement success?
Yeah, well, it kind of comes back to the sequence of returns risk. See, the stock market has averaged 12% a year since 1924. So people say, well, geez, I'll just put my money in the market and then I'll just withdraw money out of that. Well, if you have your money in a diversified portfolio and you're taking income off, you can't withdraw 12% a year. You can't withdraw 10% a year, or 8%, or 6%, not even 4%. Morningstar says the safe withdrawal rate is 2.8%. But see, to some people that doesn't make sense. If the market's average 12% a year, certainly I can take out more than 2.8. And they don't understand that, no, you can't. Because if you have a diversified portfolio, I don't care who's running that. It could be Warren Buffett. If the first 3 years of your retirement, the market goes down, 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 there isn't much else I can do for you. You're either going to have to put in more, take out less, or you likely will run out of money. That's called the sequence of returns risk. And because of this sequence of returns risk, you cannot go into retirement the same way that you saved and accumulated money. And so you've got to have a base level of guaranteed lifetime income. Now, there are three sources of guaranteed lifetime income. The first source is Social Security. Well, a lot of people know about Social Security, but they don't know what it is. Social Security is a lifetime income annuity. It's a guaranteed paycheck for life. The second source is a pension. Now, people know about pensions, but do they know that a pension is a lifetime income annuity, a guaranteed paycheck for life? And as I said, math and science says your basic living expenses need to be covered with guaranteed lifetime income. So Social Security counts and pension counts. But whatever you're short, you're supposed to go find an insurance company and buy some form of lifetime income annuity. Now, Peter, you and I have been around the block enough that we know, I've spoken all over the world. People come up to me and they say, Tom, we don't like annuities around here. Susie doesn't like annuities. Dave doesn't like annuities. Ken Fisher takes off full-page ad. I hate annuities, and so should you. We don't like annuities around here. I'm surprised. It's like, seriously? You're telling me you don't like annuities? So let me understand what you just said. You paid into Social Security for 35 years, but you're going to call up the Social Security Administration and say, stop those checks. We don't want another Social Security check in this house. We don't like annuities. Are you seriously going to do that? You worked for that company for 42 years, but you're going to call up HR and say, stop those pension checks. We do not want another pension check in this house. We don't like annuities. Well, then they say, well, I guess we like those kind of annuities. It's just those insurance company annuities we don't like. And I say, really? Why is that? Well, because they're all loaded up with fees. Really? Do you know what the total ongoing fees in a lifetime income annuity are? They're zero. It's not even a fee product. If you're guaranteed $1,000 a month for the rest of your life, guess how much you get? $1,000 a month for the rest of your life. Now, there are annuities that have fees. Variable annuities have fees. Some index annuity riders have fees. It doesn't mean they're bad. What you got to do is you got to weigh out what is the guarantee versus what is the fee. But basic lifetime income annuities are not even fee products, and people just don't understand that.
And a lot of times in annuities of the past and in your examples of Social Security and pensions, Tom, the lump sum is not transferable. If you die early with Social Security or pension, oftentimes that lump sum, the money that you've paid in, goes back into the pool to pay other people who are living longer, whereas the private annuities, a lot of times you can keep those within your estate and within your family, correct?
Yeah, and you can have the check continue to a spouse, you could have the check continue to a child, or you could have the check continue to a grandchild. I tell people these things can pay for 100 years. The key is to have guaranteed lifetime income to at least cover those basic living expenses. If your listeners only got that out of this interview, I'd be happy, because they would be much more likely to be happy and successful in retirement than the people who say, well, I got a broker and my broker handles all that. Oh, yeah? If they don't have some guaranteed lifetime income in your portfolio, you're likely to have problems down the road.
Well, Tom, you mentioned the difficulty, especially with the sequence of returns risk. If we have some down market years in the early years of retirement, I think that's an easy one. We'll all just retire in years that we know that the market's going to be up worked for the first several years.
Yeah, wouldn't that be nice? A lot of people retired at a lot of different times. And I mean, you and I both know examples. I have them in my book where somebody retired, 1 year, and 5 years later another person retired. One person's a multimillionaire, the other person's broke, and they did the same things, but they did it at different times with different markets, and people just don't understand how that sequence of returns risk can just decimate portfolios. But that's why I went into the research. Nobody's reading these PhDs white papers, but I did, and then I put it into a book that people can simply understand.
Well, Tom, why do you see that Wall Street is failing today's generation of retirees in creating the security so that they can not worry and retire happy?
Well, because the Wall Street way is just put it in the market, and the market does good over time, and buy dividends and buy utilities and buy real estate. That's the Wall Street way. Well, I don't see any PhDs writing white papers on that's the way to be optimal in retirement. Certainly those things can play a role in your retirement. That's where you optimize to protect against inflation. But I don't see anybody out there saying, buy real estate and buy dividends to cover your basic living expenses in retirement. That'd be ridiculous. And so I just don't think a lot of the Wall Street people understand the math and science behind a successful retirement. And I always, there's always a doubter out there, Peter, so I always give people a chance to prove me wrong. I said, here's all you got to do. If you think that I'm filling you full of bull or you don't believe me, here's all you got to do. Put together a portfolio that has both stocks and bonds. That's all it's got to have, stocks and bonds. Take some of the bonds out, put a lifetime income annuity in. Do you know what that'll do to every single one of your portfolios? It'll lower the risk and increase the returns. And I tell people, if you don't believe me, prove me wrong. But here's why you can't. Inside of a portfolio, the way that a lifetime income annuity works, it works like a AAA rated bond with a CCC rated yield with zero standard deviation. Hey, what if you had a AAA rated bond with a CCC rated yield with zero standard deviation? What would it do to every one of your portfolios? It would lower the risk and increase the returns. Tommy's not making this stuff up. These are mathematical, scientific, and economic facts.
Well, the economy that we are facing is more difficult than ever, and folks, you want to add some security, some stability to your portfolio, and that's what Tom Hegna has written about in his books, Paychecks and Playchecks, and Don't Worry, Retire Happy. Tom, we appreciate you sharing your time, your knowledge, and your insight on successful retirement planning with the listeners here on Your Game Plan for Retirement.
Thank you, Peter.
Well, we certainly appreciate Tom Hegna joining us on Your Game Plan for Retirement today. Folks, I want to remind you that Your Game Plan for Retirement is sponsored and brought to you here on WSC by Coastal Financial Planning Group and your local income allocation advisor, Rick Durkee. He is your resource for the type of information and planning that you hear about on the program. And if you are entering or nearing retirement, say 5 to 10 years out from retirement, and want to make sure that you are properly set up to have the type of plan that we discuss here through income allocation, pick up the phone and give a call to Rick Durkee and the team at Coastal Financial Planning Group. They offer the listeners to this program on WSC the opportunity for a complimentary, no-cost, no-obligation financial review and evaluation. Whether you have just a few questions for us about the information you've heard or would like to take them up on that offer, the number to reach Coastal Financial Planning Group and Rick Durkee is 800-491-6220. That number again, 800-491-6220. We are just about out of time on today's program. Time does move by very quickly. Tomorrow will be here before you know it. We want you to make wise and informed decisions today so that you can get the most out of tomorrow. And we certainly appreciate the time of author David Gaylor as well as the time of our very special guest Tom Hegna on today's program. And they both discussed the type of planning that Rick Durkee, president and founder of Coastal Financial Planning Group, can help you put together. If you are in and around the Charleston area listening on WFC, pick up the phone to be in touch with Rick Durkee. He's coming up next on the Retire Right radio show. In the meantime, if you would like to be in touch, pick up the phone and give a call, 800-491-6220. That's 800-491-6220. We'll talk to you next week on Your Game Plan for Retirement.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Precision Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.